Hi, this is Steve from cimabtc.com. We are going to have looked at the first type of the hedging techniques we can use. Okay, so this type of hedging techniques is called FRA. It's called Forward Rate Agreement. So what this actually means is we're going to enter into a contract, it's the binding contract with the bank. To a particular rate, we're going to borrow money or deposit money at some point in the future. So because this is a binding contract, we need to exercise this contract at some point in the future. And the FRA here is just a gambling with the bank. Either the bank wins or we win. Okay? One party would lose as a result of this contract. There's no fee payable up front. So the bank would, the winner would try to use up the contract to win money. Okay? So the differences between the rates. So use that differences to earn money as a result of it. And the forward rate agreement, if you're trying to hedge against your amount you're going to borrow or deposit, which is less than $1 million, don't think about it. Okay, the bank is not interested in that. So the FRA will be used for the large amount of money you're going to hedge against. Okay, with. So the rates, the quoted price given by the bank for the FRA forward rate agreement is similar, something like this, 2v5, etc. But what that this actually means is 2 is you're going to start borrowing money, depositing money in 2 months' time. Last for 3 months, so that 2 plus 3 will gives us 5 at some point in the future when you're trying to, you're going to borrow some money from the bank and you're going to hedge against those interest rates. So for the period of 3 over here, so that at the end of it you're going to pay back the money, okay, or get the money out if you're going to deposit money into the bank. So this is the idea behind it. And then there will be 2 prices here, left hand side and right hand side. Okay, there will be the bid price and the offer price. The bid price you're going to deposit money into the bank, and the offer price is when the bank is going to lend the money to you. But the easiest way to think about this is to try to think about if you're going to borrow some money from the bank. Of course you lose. Okay, so from the bank's perspective you lose. So you will always lose. Okay, so we are going to use a lower rate. If you're going to if we are going to use a lower rate, if you're going to deposit into the bank. If I'm going to borrow some money from the bank, of course I'll be charged more, so I'm going to use a higher rate based on that. Okay, so the example approach I'm going to use is these three steps. If you're going to borrow money or deposit money, which is the same, we're going to take the actual payments plus the win or losses from the forward rate agreement so that it can give us the net payment or net receipt. So here's the thing. So of course payment is in bracket, receipt is in positive figure, but win or lose over here is quite tricky. The concept behind the FRA agreement is that we are going to hedge against the LIBOR changes only. We're not going to hedge against the credit risk premium. Okay, so this is a very important concept. If you get this wrong, of course all of your calculations will be wrong. So because the credit risk premium will be assessed by the credit agency based upon a lot of factors. You can't hedge against those. So you're going to do is to hedge against the changes in the LIBOR rate. So what we're going to do is to take the actual LIBOR minus the fixed rate, multiply the amount you're going to borrow or deposit, so that you can gain, you can get the amount of losses or amount of gain you have. So the best way to look at this is to have looked at our example called Forward PLC. Okay, so required. Show the net payment of the FRA and the effective interest rate. So we're given 2 requirements here. Net payment effective interest rate. Why do we get net payment? Simply because we are going to borrow some money from the bank and we are going to pay it back at some point in the future. Okay, so which means we start borrowing, and at the end of which we're going to pay back the money to the bank. Fine. First scenario, if the LIBOR increases by 0.5%. So I'm going to say this question is called Ford PLC, and we're going to say, well, this is the first scenario, 0.5%. If the LIBOR rises by 0.5%, we're going to set up a pro forma firstly before actually moving any further. So in the P4 exam, for the risk management questions, I have my own mnemonics for each type of question. So please do make sure that you're going to slot the pro forma in before you're actually reading the scenario. Okay, so first one is the actual payment. Secondly, the win or losses. You're going to take the actual LIBOR rate minus the agreed rate, okay? Multiply by the amount. We move a little bit left. And multiply by the timing. So that I can end up with the net payment you're going to make. Okay. So let's have a read through the scenario then. Ford PLC will borrow an amount of $100 million in 3 months' time for a period of 6 months, which means 3 months plus 6 giving us 9, so that I'm going to use the floor prices of 3v9. Simple as that. Because you're going to borrow money from the bank, you're going to use a higher rate of 3.85% rather than 3.8%. So in the real world, that the prices quoted will be different from banks to bank, okay? So of course the 3.85 is the offer rate, but sometimes the bank would quote it as 3.8 to 3.85, so that 3.8 would be the big price, okay? But the best way to look at this is think that we always lose, okay? This is a principle. So from that perspective, we're going to borrow $100 million, and also the rate agreed here is to be 3.85, isn't it, percent? And the amount is to be 100 million. And we're going to borrow that for 6 months, okay? 6 months is half a year. So, half a year. So, next one. Ford PLC borrows at LIBOR plus 50 basis points. What does this actually mean? It's the total cost for the Ford PLC borrowed at not only LIBOR but also for the credit spread as well. This is the credit risk premium. So we are only hedged against the changes in the LIBOR rather than the right hand side, which is about 50 basis point, because it's fixed. Because you deserve that credit rating, so that it is 50 basis point for you. And we turn to the question, the LIBOR is at 3.5% over here. So if a change in the interest rate or a change in the LIBOR from 3.5 increase by 0.5%, which means the LIBOR will change from 3.5 to 4%. So from that perspective, the actual LIBOR is at 4%, okay? So that whether or not we have win or lose, of course, 4% minus the 3.85 multiplied by 100 multiplied by 1 over 2, of course we win because it's a positive figure. But from another angle, we are going to look at that is, well, we're going to borrow money, fine. We're going to borrow money at 3.85, agreed with you. But now the LIBOR actually increased to 4%. So from that perspective, we have won. Yeah. So this is the logic behind it. Because we agree with each other of 3.85%. Although the LIBOR actually increases above this level, of course you still have to give me 3.85% to borrow some money. So from that perspective, we have win. So it's to be 0.075 million after calculating that. We are posed the question that I'm going to borrow some money, and the actual rate is to be LIBOR plus 50 basis point, which means the LIBOR becomes, now is to be actual payments we need to pay back the money to you, is that is 4%, which is the actual LIBOR. We need to plus the 50 basis point. 50 basis point, 50 divided by 100 plus a percentage. Yeah. So that work out this figure, actual payment is to be minus $2.25 million. Net them off, which can then gives us the net payment of total of $2.175 million. Okay. Yeah, this is it. Very straightforward, isn't it? And also we are posed the question that we need to show the effective interest rate. So what this actually talks about is the interest rate for the company will be the interest payment, fine, but there will be additional 50 basis points as well. So we need to consider the net effect of those, so it gives us the effective interest rate. And also something we have gained or lost as a result of the FRA agreement as well. We need to take them into account as well. But how are we going to do that, the effective interest rate? Just to show you here is that the net payment over here, the effective payment is also called effective payment. So the effective payment will equals to the amount we're going to borrow or deposit multiplied by the effective rate multiplied by the time we're going to borrow money for duration of the loan or something we have deposited, the time period. So in this question we can see that we need to work out the effective rate. Yeah. So we see that the effective payment is to be 2.175 and the amount we're going to borrow is to be 100, and we don't know about the effective rate, but we know the time period is to be 6/12. So from that perspective, then the effective rate will equals to 2.175 divided by 100 and then multiplied by 12 divided by 6. Okay, just to swap it around so that it gives us the effective rate is to be 4.35%. Okay, over here. Another way we can calculate the effective rate is that we're going to use the rate we have agreed to take, irrespective of change in the interest rate as a result. The rate we're going to take is to be 3.85%. We're going to plus the credit risk premium, or we can call it spread. In this case, the credit risk premium or spread is 50 basis point, which means 50 divided by 100 plus a percentage, giving us 0.5%, giving us a total figure of 4.35% over here. Okay, simple as that. Just an exercise for the part B. If the LIBOR decreases by 0.5%, so I'm going to show you here the pro forma firstly. It's about the actual payments because we're going to borrow some money. Of course, you can work that out, the amount multiplied by the actual interest rate multiplied by the time period. Win or loss. Okay, you're going to take the actual LIBOR minus the fraud rate. Okay, multiplied by the amount, multiplied by the time period, and then you can get your net payment. So, all else being equal, we're going to see that the company is going to borrow 100 million. I'm going to write that off firstly, before actually moving any further. We're focusing on part B. Borrow $100 million for 6 months. Okay. And we're posing the question that the LIBOR is currently at 3.5%. If there's a decrease in LIBOR by 0.5%, if that is the case, the actual LIBOR will become 3%. So the actual LIBOR is 3%. And then the rate we have agreed is to be 3.85%, so that we lose, okay? And the total amount, calculate this together, giving us $0.425 million, okay? And the company will borrow at LIBOR plus 50 basis points. So from that perspective, the actual LIBOR is 3% plus 50 basis point, giving us 3.5% for the actual rate. So multiply by this all together, giving us a total figure of payment of $1.75 million. So plot this together, giving us the net payment of $2.175 million. Okay. So what about for the effective interest cost then? So the effective interest is that we're going to take the 2.175 divided by 100 multiplied by 12 divided by 6, giving us 4.35%. Or you can equal to the fraud rate, 3.85, because we need to take it whether or not the LIBOR rate actually increases or decreases, and plus the credit risk premium is to be 0.5%, which will gives us 4.35% over here. So remember, in the exam, if you can see that the examiner asks you to use the FRA to hedge against the risk, of course, use the pro forma here.